Hello everybody, this is Jason Wink. Today is Friday, August 26th. It's about 1 o'clock p.m. And as I record this, the markets are up nicely. They started actually down over 1%. You can see that this morning. And then they have since rallied up nicely. So reason for the update is on Monday when I recorded a little video, I talked about a couple key areas that we're watching. And the main area I was looking at was about 1,165 or 1165 on the S&P, and I thought it was pretty critical if we wanted to see a market recovery from this latest drop that it needed to hold those levels this week. And so far that's been the case with the market at 1174. It's a little bit above that. So I don't think we're quite out of the woods, so to speak, but I do think that this has proven to be so far just a kind of a nasty short-term correction. And there's a pretty good possibility that the market will get above 1,200, and then if that happens, I think we'll find that the rally will continue in the short run. There's still some risk though, so as I've mentioned before, the best medicine in a market like this is being conservative and balanced. That means that you might only get a portion of the market's upside and the portion of the market's downside. It certainly isn't strong enough right now to be extremely aggressive. But if the market, I think, takes out 1,200 and moves higher, then we'll be wise for a little bit more aggressive portfolio. And by aggressive, don't mean 100% in stock, just meaning that a lot of our hedges against risk should possibly go away and be more fully invested into the appropriate allocation. So in other words, if someone should have a balanced portfolio, which might be 60% growth, 40% income oriented. Right now, our portfolios only have about half of the normal equity positions. So for us, we'd be like 30% growth and 70% income, even in a balanced portfolio. I think that's smart in the interim because there is still some risk that the market could fall down and touch this 1,100 mark again. So far, it's been about a 15% decline from the market's peak to where it is today. If it gets above 1,200, I see it starting to move back up again. But if it somehow struggles and doesn't quite get over that mark, I think it'll be testing, going back down to 1,100. The long-term momentum is still looking like it could drop. You can kind of see that here up at the top. This is what's happening here. And if that doesn't change, we could see this fall. That would be going step in step with the market falling. And this is the moving average convergence divergence. Shown this before, but if this breaks through here, a lot of times, in other words, you see the black line there. Right now, it's getting real close to touching the red line. When it goes through, like it did back in 2008, oftentimes that's indicative of a longer-term bear market. And you can see, obviously, when that happened back in late 07, early 2008, the decline was pretty severe. So we have to be on the watch for that, but it hasn't happened yet. And there are certainly times when it looks like it's coming close, and then the market, recovers. Like you can see that right around here, 06, 07. A couple times it looked like it was going to happen, but it never did. Of course, when that never happened, the market kept going up and up and up. So obviously we want to try to participate in that market upside, but we want to be watching this carefully. That's why I keep saying that we have to be patient, have to be balanced, diversified, conservative, and then see if this plays out. If it does, we have to get, again, defensive. But for now, it kind of looks like it may want to resume its upside. All that being said, we have calculated our recession probability indicator for this month. That came in at 46.19. And you may remember that anything over 50 is rather bearish. That just means that there's the economy would be in the bottom 50% relative to its previous historical measurements. So if that happens again, another sign that the economy is weakening. One other thing too, just hope everybody heeded my warnings on this. I mentioned that I thought gold was getting a bit overbought, and so I'll pull up the gold chart. And it was when I said, hey, it was getting dangerously close. I think, in fact, it was on the day that it was right up at that peak to the most overbought gold had been. Of course, since then, gold has dropped to about 100 and maybe $50 or $60 per ounce. I think that may actually continue declining a bit until gold is somewhere around 16, maybe 50, or even a little bit lower. So want to be careful on the gold front. The other thing people were rushing into was treasury bonds. Those also have had a bit of a sell-off from their highs. Very similar pattern as what gold had. Even though the long-term trend was certainly up, there's been only one other time that so many people rushed into bonds because they were producing returns. That was back here, and that was the peak sort of the financial crisis. And when that happened, of course, it went right back down to where the long-term treasury bonds should have been. So, little update for today. Again, hope everybody had a good week. I know for us, it's been a trying few weeks, just trying to make sure that we communicate as regularly as possible what I see happening in the market. I do think, though, as I said, if I look at some of the shorter-term measurements, excuse me, in the S&P, this is a weekly one that I've shown before. Drew a couple lines, and I can see that there's a bounce effort of sorts coming in. I do think that'll take the market back up into sort of the support, this blue line here in this wedge, which is right about 1200, and it either is going to break back through and create a new uptrend, or if it bounces off that, I think it'll go all the way down to 1100 and perhaps lower. So we have to be very cautious, but things are better this week. It's always a good and welcome sign, and I suspect in the next 2 or 3 weeks we'll see if the momentum breaks through, and if the prices break through, and if that does happen, then I think we'll want to be positioned more so for growth. But the smart play until all of that happens is just to be conservative. We have to keep in mind that when we start to see just short-term choppy trading like what we see right here, we can't be concerned with if our portfolios are doing the same as the market, because in the short run, that can just create a lot of confusion. If we are patient and we wait for something to break out of sorts, usually the rallies will last for a while. You kind of see last summer we had this whole pattern very similar to what we're going through right now, and the market ultimately was able to break out of that. It looked like it could be pretty nasty, but the market stayed within all of the appropriate zones, ended up breaking out, and when that happened, there was about a 25% rally between sort of September, October, and January, February of this year. So, I don't know if that'll happen again, but that certainly could be the case. So until we either see this breakout to the upside or some type of breakout like we saw here to the downside, the smart play is just letting the volatility play its course and then making a decision when there's a lot more clarity. And right now there just isn't a whole lot. So I'll keep everyone posted. I hope everyone has a wonderful weekend, and I'll probably give an update sometime early next week, and perhaps do a couple videos next week. And I'll also be writing a post too about the recession probability indicator, kind of show you where it is and historically the significance of that. But again, in the short run, just know that our recession probability number is on the rise, which means that the economy is getting weaker, but it's still in what we consider to be a safe zone. I don't know if safe zone is the right term because it is deteriorating, but until it goes above 50, we're not going to take any massive action because that's the statistically smart thing to do. So again, hope everyone has a nice weekend. I'll be back in touch next week. Of course, if you have any questions or comments, there's a box on the post that you can write those in. I'm always happy to reply. And if these videos have been helpful and you know other people that might benefit, feel free to just forward this. If you're getting it via email, forward it on to folks. I always appreciate getting more readers. We've seen about 300 new people sign up for my blog posts in the past 30 days. So evidently it's going well and people are enjoying it, and it's my pleasure to make these videos for you. And so again, appreciate in advance if you have anybody you'd like to forward this to. We'll be in touch. Thanks.